Hello friends. Today we will discuss another topic in financial inclusion, which is finance for the poor. What are the financial needs of poor? Consumption for seasonal variations in cash flow and for consumer durables like television, refrigerator and more. Emergencies. It comprises of personal, for example accidents, illness among others, as well as impersonal, mainly natural disasters. Investment for acquiring assets like land and housing. Life cycle needs. They deal with the needs arising due to events like birth, education, old age, retirement, and ill health, social and religious purposes, death, marriage, festival, etc. Poor people often lack access to safe, affordable, convenient, and reliable ways to manage their meager resources. As a result, they face exclusion from both the society and the financial system. Access to finance is critical for both an individual's and a country's development. Finance is as much a part of a country's basic infrastructure as roads, transport, and housing or electricity. Contrary to common impressions, poor people need and use the same variety of financial services and for the same reasons as wealthier clients, like educate their children, improve their homes, cope with contingencies, seize business opportunities, and build assets. Financial inclusion is broadly defined for consumers as access to cost-effective means of managing their financial lives, spending, borrowing, saving, and investing, and protecting their financial well-being through insurance. For businesses, it may be construed as having access to fairly priced funding and working capital facilities, insurance, and efficient means of managing their revenues and expenses. Household access to financial services like contingency planning, retirement savings, buffer savings, insurable contingencies, businesses, and livelihood. Credit like emergency loans, housing loans, and consumption loans. Wealth creation, savings and investments based on households' level of financial literacy and risk perception. What is financial exclusion? Financial exclusion can be described as the inability of individuals, households, or groups to access the necessary financial services in an affordable, convenient, and hassle-free manner. People who are financially excluded might not be able to access affordable, adequate, and timely credit. They may struggle to budget and manage money or plan for the unexpected. What are the implications of financial exclusion? Dependency, inability to access benefits due to living exclusively with cash, impossibility of saving money or access to credit and therefore investing or starting a business, inability to improve situation via financial tools, inability to join financial mainstream and avail government market benefits, when faced with income shocks on account of natural disasters or health emergencies, households are forced to take on sell assets to remain afloat. Those with access to accumulated savings are able to maintain consumption levels with consistency and avoid drastic measures such as distress sale of assets. What are the mantras of financial inclusion? Easy to understand, accident, life, and health insurance, a reliable way to send and receive money, a safe place to save, an avenue to engage in saving for old age, a quick way to borrow in times of need or to escape the clutches of the moneylender. What is the bank's role in financial inclusion? Create a simple, needs-based product set. Transact, save, borrow, invest, and protect. Multiple customer use cases built on an open platform that are affordable, transparent, and include activity-based pricing. Build low-cost branches, taking advantage of hub and spoke servicing, extend agent network with correspondent branches and agents, create simple banking processes, focus on customer needs and financial education, enable customer self-servicing and instant rapid customer fulfillment, target straight-through processing with zero back office, automate controls and risk decision making, introduce digital customer credit and identification analytics. Measuring financial inclusion. Quality. Quality considers the attributes or relevance of the financial service or product to consumer needs. Quality is determined by the nature and depth of relationship between the financial service provider and the consumer, including the choices available, the financial capabilities of the consumer, and how those capabilities affect the experience. Indicators include the financial capability of consumers, choice of services and providers within a reasonable distance, and frequency of complaints. Welfare. Welfare, the most difficult outcome to measure, focuses on the impact that financial services have on the welfare of consumers, including changes in consumption, business productivity, and quality of life. Indicators include increased savings, increased consumption, and increased decision making in the household. Access. Access refers to the ability to use financial services, taking into consideration physical proximity, affordability, and eligibility. Understanding levels of access may require insight and analysis of potential barriers to access. Indicators include number or percentage of people who access a certain type of service, from whom, client touch points within a certain distance, and poverty levels. Uses. Uses refers to the actual use of financial services and products. Determining uses looks at the regularity, frequency, and patterns of use over time, including the combination of services. Indicators include frequency of use or percentage of active accounts. What are the features of ideal financial services for microclients? The required minimum opening balances should be reasonable. A mix of liquid saving products, semi-liquid saving products, and time deposits with a fixed team structure are offered, including at least one liquid saving product with unlimited withdrawals. Attractive rates of interest are offered. For private MFIs, this may mean rates of interest that are higher than market rates as a sort of risk premium to attract deposits, particularly if they are operating in a competitive environment. Public MFIs may be able to pay lower rates of interest based on the perceived safety of public institutions. Interest rates should increase with the size of the saving account to provide a financial incentive for savers to increase deposits and refrain from withdrawing. Conversely, savings account balances below a specified minimum may be exempt from interest payments to partially compensate for the relatively higher administrative costs of small accounts. Some MFIs may charge fees and commission to depositors for opening and closing accounts and for specific services related to account management. These should be affordable. Thank you very much for watching us. If you want to build a great career in microfinance, please enroll yourself to SIFI Institute of Financial Inclusion. Thank you.